survey and asked the market what's it equivalent to, and they think another 35 basis points of hiking from 25 to 50. As I've talked about that to people, some people say maybe.
All right, so we are back here, and we have sold off a little bit in the last few minutes. E-minis now up only 2 points. NASDAQ down 32. Dow up 53. We are awaiting comments from Powell coming up soon on CNBC. But we definitely have sold off a little bit here. The VIX still down 1.25 points. You know, in a sense, I'd rather have it be like we sell off immediately and then we build into a rally than have it be something like, you know, we get a big rally and then all of a sudden it's not up so much. Because if we had just gotten like a huge rally right off of this and then the rally slowly started to fade and then it's not up that much and then all of a sudden it's, you know, it starts tanking, it's way down, that kind of momentum would not be good. In a sense, to have it be down a little bit initially, then maybe we can build off of that into a rally here. I don't know why I'm rooting for a rally. I guess because I'm short volatility a little bit. But anyway, but we'll have to see as they digest these comments what happens. Like I said, it's kind of a little bit of a non-event here. I appreciate everybody coming on and watching this, but there isn't a whole lot to say right now because we kind of expected that we were going to get the hike, and we've gotten it, and we also expected that maybe they would soften the language because, of course, the market has been down since the last Fed decision, and you know it seems kind of counterintuitive to be raising rates when the markets are down. But the thing is, once again, let's look at this chart here. Even though the markets are down, you know that's the kind of thing we're coming off of, you know, years of awesome growth in the market. So, they, you know, they see the economy as doing well, and raising rates is definitely signaling that the economy is doing well enough that they have to kind of cool it down by raising rates. So, the commentary that they had on CNBC saying, well, this is Powell being confident about the markets and not bowing to pressure and all that stuff, that could be seen as positive for Wall Street. We're starting to put together a little bit more of a base here. You know, I've always thought that, like, if we can start moving sideways for a while as opposed to down, then the story becomes one of we're moving sideways as opposed to like, uh-oh, look out below. And you know, not having velocity to the downside could attract buyers here. We are awaiting comments from the Fed and the press conference that's supposed to start at 2:30. Now, those are usually really boring to listen to the commentary from the Fed because usually they try to say as little as possible in as many words as possible. But yeah, this is sort of a non-event. The stories of the day now are still Facebook down on lawsuits being announced, and then FedEx, the chairman, coming out and saying that the political situation is what's caused the problems in the stock today. Really surprising interview with the CEO of FedEx this morning. And the stock is certainly disappointed, but not unlike many other stocks. I'm looking at United Healthcare here for a second, where the this is one that TheoTrade was talking about shorting. And let's take a look just at the 20-day chart, and they've done really well shorting that, obviously, but it was mounting a little bit of a rally today, but that seems to be fading. However, the broad markets really aren't going one direction or the other here right now, and I think if that continues, that's going to be a victory for definitely for the short vol, but also for I think for longs. If we can stay and hold here and not sell off, that all helps the case to the upside to sort of build a base, stop the the downward momentum, because let's face it, we do have downward momentum right now. We've had a lot of a sell-off. This is the chart for what is this, a 20-day chart? Yeah, this is the 20-day chart for the E-minis, and we are going down right now. So anything to stop that, even if it's sideways, is a case for the upside at this point. As we see, the VIX is down over 2 points so far today. And as I discussed before, the term structure very flat besides the one future that expired today. And if we stay around this area, this is a victory for the bulls, I would say, because we've held on. It looks like we're holding on. I don't know if we ever went negative in the Dow. If we did, it was only briefly. And NASDAQ back in the positive now. E-minis plus 15. And if we can hold on to the gains here, I think it's a bullish sign that maybe not necessarily bottoms are in, but maybe the trend is going to be start to be described as sideways as opposed to down. Now, if you are long puts or long volatility, this situation is not necessarily over. We are awaiting the Fed speech coming up, and we certainly could have more fireworks to the downside. This situation is not over by any stretch. Let's see what we've got on CNBC now.
Dollar deficits. So we don't need any more monetary stimulus. We have to get to neutral, and because we don't want the monetary stimulus to continue to inflate asset prices, which will then get into a bubble and burst, and we've already seen some of that in the stock market. I think that two is.
If we rally. If we actually do put together a rally and come off the lows here, everybody and their mom is going to say how they bought the market down here and got long down here. And as far as I'm concerned, I did have cash on the sideline, but I did buy some stuff yesterday. I did turn some of my cash into being long some of this stuff. And what I bought was I did buy XOP, which is an oil and gas type thing, because I think $49 for a barrel of oil sounds pretty cheap to me. And so I did buy some of that, and I did buy just some broad market quote unquote stuff. I bought J&J, and I bought a little bit of this USMV, which is the low volatility ETP. So you'd hate for this big sell-off to happen, and then it goes right back to the highs, and you weren't able to take advantage of it either on the upside or the downside. So I have bought a little bit down here for my longer-term holdings, but I certainly haven't backed up the truck, because we certainly could just chop lower. My opinion of the market for the next couple of months is that we chop sideways to down. I don't think we return to just what we had last year of vol in and slow rally. I think volatility stays up relatively high and we chop around a bit. This certainly doesn't appear to be a definitive event. I mean, this sort of was a non-event, and non-event means that until we see something to change it, we are in a downtrend here still. So we'll have to see what happens on the speech coming up. But markets are basically not doing a whole lot right this second. Volatility is in 2 points, but that sort of makes sense because it was up above 25, and market sort of unched here. You would expect it to be in a bit. UVXY currently 68.45. It was down to as low as, I believe, 67, even around there, but back up a little bit now. You can see it spiked. Let's take a look at UVXY chart real quick here. So you can see it spiked right after the Fed announcement. Now it's back down a little bit. But the markets are basically unched right now. NASDAQ up 17, E-minis up 16, Dow futures up 157 as we await the Fed talking. The Fed did raise rates a quarter point, which was largely expected, and the president had come out saying not to raise rates, and we'll see if there is a reaction from the president. I keep updating my Twitter feed here. Nothing yet from that camp, and we are awaiting the Fed speech coming up at 2:30 here. Right now it's 2:24, and we have seen sell-off in Facebook as they, but it's off the lows at this point. I think it got down, it got down to 133. Now it's 136. Let's take a look at J&J. Now J&J had a lawsuit about talcum powder being, I think, carcinogenic. I did buy a little of this yesterday. I think I paid $130 for it. This is really sold off a lot lately, so this is kind of the same story as the rest of the market in a way that it had that big down move, and it has to stop falling before it can rise here. But we'll see if J&J can recover. I guess a news story just came out saying that a federal judge is not going to allow the current resolution of that talcum powder lawsuit. They're going to have to go back and renegotiate a little bit more. So that bearish news story for J&J, but it seems to be kind of hanging in there okay right now. Tilray is kind of creeping lower again. After this morning it was up to 80, but now it's kind of grinding lower, which isn't totally unexpected here. If we look, it got up to 83 this morning, and then it's just been grinding lower. It got down to 68 and change, or 64 a couple days ago, and it looks like it's headed right back down there again. The MJ industry not performing great right now. Ever since legalization in Canada, which was at the end of October, we really have seen stuff just kind of fade. CGC now 28.74. We had Afria with the short sellers and then get crushed. It's kind of been a dead cat bounce since then. I mean, some would say it's rallied, but we got down to 375, but then it's just chopped around between 5 and 6 for a while now, and I would kind of expect that to continue as there's a lot of bag holders in there from higher up, of course. And we're still awaiting the press conference. We've got 3 minutes to go for that. Nothing from the president as of yet. But, people saying, the president shouldn't get involved with the Fed, blah, blah, blah. This is a tradition where many, many presidents have gotten involved with the Fed and tried to influence things. And, the president has more things to worry about than just the market. And I think in a sense it may have been a smart thing for him to come out against the Fed raising rates, because now he's got cover. If the market tanks from here, then the president can come out and say, look, I told you shouldn't have raised rates. And it gives him a little bit of cover for the sell-off. And as I said before, until further notice, we are in a downtrend. So it would be nice if we break the downtrend here and start going sideways. But, I mean, you look at any of these charts, we're still in a downtrend until we're not. So this could be a turning point here. We won't know that, though, until sometime in the future. We are starting to build more of a rally at this point. Let's take a look at the daily and the E-minis. We have not reached the high of the day yet, but we are starting to rally a little bit. You can see the initial chopping around, and then we're starting to build off of this. Like I was saying before, it's kind of nicer to get a sell-off and then a slow rally than it is to get a knee-jerk rally and then it all fades and we just start ripping lower. At this point, we're not ripping lower, and I mean, it's not impossible that we rip lower from here, but this is a good result so far for the bulls, and I think I think the Fed would be happy with a kind of a non-event type event, because that means that they prepared the markets for what they were going to do and they executed on their plan. Still waiting. We're 1 minute away from the Fed's speech here, and it will be excited to see actually what they say. And what do we see? Richie Lee. Want to bet that the Fed will lower forecast for growth and gold will pop? No, because I kind of agree with you on that one. Hey, James Bond is here. Wow, awesome. James Bond is watching. Very exciting. All right, so let's see if I keep checking back to CNBC here to see if they Fed news conference imminent. Thank you for all the support from everybody. I'm going to load up on V-Leaps again, 140, 145. Okay, so how are you positioning yourself, folks? Has anybody been trading after this announcement came out? I am still short UVXY here, and I feel comfortable for right now with my position. I did buy the UVXY Jan 16 67.65 put vertical. I paid 110 for it. My thought is that I will turn this into a condor. I would love for us to rip lower. Let's say if we rip to 62 today, then what I would do is I would turn around and here, let me put this under my custom setup here so that you can see. This way it shows my position on the screen. All right. I would love, I'm standing right in the way of it here. Hold on, let me move out of the way for a second. I would love for this to rip lower and then so that I could sell. This is a $2 put spread that I bought. I'd love to sell a $2 put spread against it. Right now, if I were to sell the 51.49 put spread, it says negative 3 cents. But essentially, you could probably sell that for about 40 cents right now. But if we would rip way lower and I could sell this for like $1, that would be a beautiful thing. So the market back to rally mode now. Let's take a look and see if we have the, here we go with the speech. I'm going to shut up. We can listen for a second.
I'll explain how my colleagues and I are incorporating those cross currents into our judgments about the outlook and the appropriate course of policy. Since September, the U.S. economy has continued to perform well, roughly in line with our expectations. The economy has been adding jobs at a pace that will continue bringing the unemployment rate down over time. Wages have moved up for workers across a wide range of occupations, a welcome development. Inflation has remained low and stable and is ending the year a bit more subdued than most had expected. Although some American families and communities continue to struggle and some longer-term economic problems remain, the strong economy is benefiting many Americans. Despite this robust economic backdrop and our expectation for healthy growth, we have seen developments that may signal some softening relative to what we were expecting a few months ago. Growth in other economies around the world has moderated somewhat over the course of 2018, albeit to still solid levels. At the same time, financial market volatility has increased over the past couple of months, and overall financial conditions have tightened. That is, they have become less supportive of growth.
You think?
In our view, these developments have not fundamentally altered the outlook. Most FOMC participants have instead modestly lowered their growth and inflation forecasts for next year. The projections of committee participants released today show growth continuing at healthy levels, the unemployment rate falling a bit further next year, and inflation remaining near 2%. The projections also show a modestly lower path for the federal funds rate, which should support the economy and keep us near our goals. As the economy struggled to recover from the financial crisis and the subsequent recession, the committee held our policy rate near zero for 7 years to give the economy the best chance to recover. And the economy did recover, steadily, if slowly at times. 3 years ago, the committee came to the view that the best way to achieve our mandate was to gradually move interest rates back to levels that are more normal in a healthy economy. Today, we raised our target range for the short-term interest rates by another 1/4 percentage point. As I've mentioned, most of my colleagues expect the economy to continue to perform well in the coming year. Many FOMC participants had expected that economic conditions would likely call for about 3 more rate increases in 2019. We have brought that down a bit and now think it is more likely that the economy will grow in a way that will call for 2 interest rate increases over the course of next year. We always emphasize that our policy decisions are not on a preset course and will change if incoming data materially change the outlook. And given recent developments, the statement notes that we will continue to monitor global economic and financial developments and assess their implications for the economic outlook. Now I will provide some additional context and detail, starting with a review of policy over the last year. Last December, the unemployment rate was 4.1%, and inflation had been running just below 2%. FOMC participants and many other forecasters were predicting that growth in 2018 would be strong. This growth was predicted to push the unemployment rate down to near historic lows, and the increasingly tight labor market was expected to help push inflation up to 2%. Given this outlook, committee members judged that the appropriate way to sustain the expansion with inflation near 2% was to continue gradually withdrawing the extraordinary support for the economy that had been in place for almost 10 years. Thus, in December 2017, the median of the projections of FOMC participants pointed to 3 quarter-point interest rate increases in 2018, which would have left the target range for the federal funds rate at year-end at 2 to 2.25%, still below most estimates of the longer-run normal rate. Early in 2018, it became clear that the economy was likely to be even stronger than we had expected, in part because the fiscal stimulus adopted near the start of the year was larger and more front-end loaded than most had anticipated. The signs of a more robust economy proved accurate, and the FOMC has now raised rates 4 times this year, counting today's action, 1 more time than anticipated in the median projection a year ago. This illustrates the nature of data dependence that we always emphasize. In 2018, the economy was somewhat more robust than expected, and this led to a slightly faster pace of policy normalization than had been projected. When the economy has instead turned out weaker than expected, the committee has slowed or paused the pace of rate increases, as we did in 2016. And when the economy has performed about as expected, the committee has generally moved in line with the median projection, as we did in 2017. What kind of year will 2019 be? We know that the economy may not be as kind to our forecasts next year as it was this year. History attests that unforeseen events as the year unfolds may buffet the economy and call for more than a slight change from the policy projections released today. With that caveat, there are 2 important differences in the policy outlook today versus next year. In early 2018, we saw a rising trajectory for growth. Today, instead, we see growth moderating ahead.
And it
FOMC
looks like,
along with many other
if we look at the VIX futures right now, we see them dipping actually into a contango situation with the front month dipping just slightly below the second month here. And we could see a situation where we're slightly in contango today, even with us being inverted with spot, which would be very interesting.
With growth remaining next year above its longer-run normal value, the unemployment rate is projected to fall a bit further to 3.5% by the end of 2019.
I feel like Powell's coming across well here. He seems confident. They seem like it's business as usual here.
Continue to strengthen this year, and given our 4 rate increases and the ongoing reduction in our portfolio, monetary policy will be providing a smaller boost to the economy in 2019.
As we said before, raising rates is kind of can be seen as sort of undoing the measures that were taken before to stimulate the economy, whether it be acute quantitative easing plus lowering rates. This is undoing stuff and sort of resetting stuff. If we don't reset stuff, then when there's a real downturn in the economy, arsenal of tools, our quiver of arrows, is empty.
The FOMC makes policy in light of the array.
So when we talk about volatility trading, when we talk about us normalizing the term structure and it normalizing into contango, well, for the Fed, normalizing means getting rates back up to a normal level, because when you have rates at zero, where do you go from there? But if we can get rates up a little bit now when the economy is doing well, then we're reset for later.
We sometimes point to the median of these projections to illustrate the broad middle of views of the committee. Each participant's projection represents appropriate policy under the baseline outlook provided by that participant. We believe that the SEP provides useful information about committee participants' thinking, but the median is not a consensus judgment and certainly does not represent a committee plan. Actual policy will, as always, be adjusted as incoming data shed light on the state of the economy, the outlook, and the changing balance of risks. Neither the pace nor the ultimate destination of any further rate increases is predetermined. We will adjust monetary policy as best we can to keep the expansion on track, the labor market strong, and inflation near 2%. We know that our policy decisions affect all American families and businesses.
And we are seeing vol come in a little bit here as the VIX dips below 23. Now, it's definitely unclear whether this is a buying opportunity or a selling opportunity in the VIX. I know people will take an opportunity to buy some of these issues, and there certainly is no penalty right now for buying UVXY or TVIX. We are flat to in backwardation. Even though we may be flat in the term structure, when you have spot above all the futures, there is pressure to the upside here. And even though there's not pressure from backwardation, there is pressure from just by virtue of the fact that spot is 2 points above any future at this point. That is pressure pulling these futures up. And so there is no penalty for buying UVXY or VXX as a way of getting long volatility right now. So if you are considering doing that, don't let the term structure hold you back, because the term structure is right now advantageous to be buying a UVXY or a VXX. It may not be that way forever, but right now it's advantageous. It's going to take us quite some time for the term structure to normalize. I mean, we would need, if the VIX went down a further 2 points, it's already down almost 2.5 points. If it went down, it would need to go down a further 2 points just to get flat at this point. So we are far away from normal in volatility right now.
The Fed has had any discussion of altering the course of balance sheet normalization, and if you could give us any insight on what might lead the FOMC.
Jerome Powell now taking questions, and we're starting to sell off again here.
Some years, I think people who were working at the Fed in 2013 and 14 took away the lesson that the markets could be very sensitive to news about the size of the balance sheet, the pace of asset purchases, the pace of runoff, and things like that. So we thought carefully about this, on how to normalize policy, and came to the view that we would effectively have the balance sheet run off on automatic pilot and use monetary policy, rate policy, to adjust to incoming data. And I think that has been...
If this Fed speech appears boring to you, that's the point. They don't want to make news in this speech if they can help it, so it usually is boring like this. But they parse out every word he says to have big meaning. I would say maybe hang out, wait another hour or so before you make any big moves.
Nick Tamaros at the Wall Street Journal. Chairman Powell, you talked a little bit earlier about the ability to be patient. And so as you think about your next policy moves, are you inclined to go at the current...
Oh, that's good money maker. I was wondering if you had actually waited till we spiked and then sold something. That's good. Yeah, all profits are good profits. And this kind of market is a market where when stuff starts to go your way, it's good to take profits, because you just turn you know, you wait 10 minutes and the situation could have completely changed. This is not the kind of market where you want to like get short or long vol and then just hang out for days and weeks at a time to do this huge swing. No, you want to get in, you got to move your way, you take your profits, you move on.
That's a reasonably positive forecast. Going forward, you know, I will be looking in particular to see whether incoming data tell us that we're in fact on that path, that the development of the economy is in line with that expectation. That will be the main thing. More broadly, though, I think we've reached the bottom end of the range.
I wonder if Powell is like looking at a ticker next to him. I wonder if he sees the market going negative right now and he starts sweating and like changes what he's going to say or something. I'm sure he doesn't, but he's got to watch how the market responds to what he's saying. And, you know, they say, oh, they're not affected by the market. They're not really, you know, that the market is not the key thing for them. But I'm sure they have to be watching this. And we are at the lowest point we've been today right now in the E-minis. We have sold off to the lowest point today. We'll see if this is another head fake or not. I am encouraged by the fact, though, that we just didn't completely tank right out of the gate here. People have to be thinking that at least some of these stocks are you know, at a discount now, and it has to be attractive to buyers, some of these issues that have gone straight down. Hi, Sandra. Welcome. I'm feeling guilty about not having... Let me just say that actually while we're in front of everybody, please check out Sandra's website. I will post links to it in the description. I'm feeling guilty about not having finished your project yet. But I hope you're doing well, and I hope you have a good holiday, and we will talk more in private about it. And it looks like... Well, we did crack the low of the day today, but we are kind of holding here. Let's listen in a bit more.
Things develop. I think more broadly, there's been a sense of concern among business people and market people about global growth. And, you know, that may be partly about trade tensions. It may be partly about a variety of things. If you just mechanically drop into a model of the U.S. economy tariffs, you don't see very large effects. The large effects would have to come from financial market changes or from losses in business confidence, and those are things that are very difficult to model. On your third factor, you know, political considerations play no role whatsoever in our discussions or decisions about monetary policy. We're always going to be focused on the mission that Congress has given us. We have the tools to carry it about. We have the independence, which we think is essential to be able to do our jobs in a non-political way. And you know, we at the Fed are absolutely committed to that mission, and nothing will deter us from doing what we think is the right thing to do.
Oh, and now we're talking. He's talking directly to the president right there. It seems like, doesn't it?
Benny Applebaum, The New York Times. You're about to undershoot your inflation target for the 7th straight year. Your new forecasts say that you're going to undershoot it for the 8th straight year. Should we interpret the dot plot as suggesting that some members of your committee believe that policy should be in a restrictive range by the end of next year? And if so, can you help us to understand why people would be advocating restrictive monetary policy at a time of persistent inflation undershoots?
Well, we, as a committee, we do not desire inflation undershoots. And you're right that inflation has continued to surprise to the downside, not by a lot, though. I think we're very close to 2%. And, you know, we do believe it's a symmetric goal for us. Inflation is symmetric around 2%. And that's how we're going to look at it. We're not trying to be under 2%. We're trying to be symmetrically around 2%. And I don't, you know, I've never said that I feel like we've achieved that goal yet. The only way to achieve inflation symmetrically around 2% is to have inflation symmetrically around 2%. And we've been close to that, but we haven't gotten there yet. And we have not declared victory on that. So that remains to be accomplished.
Hi, Gina Smilik, Bloomberg News. Just following up on Binya's question. I guess if you haven't achieved 2% inflation and you don't see an overshoot, which would be sort of implied by a symmetrical target, what's the point in raising rates again at all?
So again, I go back to the health of the economy. If you look at 2018, as I mentioned, this is the best year since the financial crisis. You've had growth well above trend. You've got unemployment dropping. You've got inflation moving up to 2%. And we also have a positive forecast, as I mentioned. And in that context, we think this move was appropriate for what is a very healthy economy. Policy at this point does not need to be accommodative. It can move to neutral. It seems appropriate that it be neutral. We're now at the bottom end of range of estimates of neutral, so that's the basis upon which we made the decision. I also think we took on board, the risks to that, and we're certainly cognizant of them.
Marty, and then Mike.
Mr. Chairman, Marty Kretzinger with the AP. You've established for this coming year a communications panel to look at how the Fed communicates. Could you talk a little bit about what you expect to get from that panel? And will the dot plot be involved in that at all? How do you think the dot plot is working? Are we dealing with it the way that you want us to be handling the dot plot, or is it something that you might tweak a bit?
So this review, what it really is, it's coming at a time when the economy is strong, and it's a good time to take a step back, we think, and ask whether our strategy and our tools and our communications around monetary policy are doing the job that Congress has assigned us to do on behalf of the American people. And what we're going to do is we're going to open ourselves up and have a discussion.
I think the dot plot is this thing that they release that tells what different Fed members' ideas for rate changes and things like that should be. And they release it. They're trying to be more transparent with what they're doing, and I think that's a good thing. But I think that's what the dot plot is that he's talking about right there.
Rates have been really coming down overall for more than 3 decades now. We may be in a world where interest rates are just lower for the time being, and therefore we'll have less policy space to react to economic downturns. And we'd want to be evaluating ideas for, again, for better achieving the goals that Congress has given us. We're not looking at law changes at all, and we're not looking at changing the inflation target, for example. We are looking for better ways to achieve the inflation goal, for example, on a symmetric basis. So that's the sense of that. So as I mentioned on the dot plot, you asked about the dot plot. I think the dot plot generally does provide useful information about the reaction function of committee participants, sometimes more useful than others, I'll admit. But in general, I think people sort of have it figured out and understand what it is and what it isn't, but that doesn't mean we don't like to repeat what it isn't, which it's not a consensus forecast. It's not something that we vote on. It's something that each of us writes down, and we always update it as data come in and as we update our outlooks.
Okay, Mike, and then Edward.
All right,
Michael
so
McKee from Bloomberg Radio and Television. The balance sheet reduction, how much additional tightening do you think has come from that? We note in the markets that the cost of credit rising, commercial paper, repo rates, the TED spread widening. Do you see any...
All right, so we're starting to roll over here a little bit, folks. We'll see if this continues, but we're definitely heading lower, it seems here. The VIX only down 88 cents right now, and UVXY up to 70.60. It feels like we're starting to roll over here. Whether this is another head fake or not still kind of remains to be seen. But we're definitely still heading lower. We did take out the lows from before, but we'll have to see what happens. I have no crystal ball here, but so when the interest rates go up, the market goes down is the question. You know, it varies. Interest rates can go up and market go up, down, or sideways. Nobody knows what's going to happen ahead of time, and it can happen very differently. It's the same with earnings. Earnings can be good, can be better than expected, and the market can go up, down, or sideways. Earnings can be worse than expected. The market can go up, down, or sideways. Nobody really knows what's going to happen ahead of time. And that's what makes this such a big event and makes it so challenging. Dr. J had a good point. He was talking before they announced the rate thing, which was, well, you know, if they were worried about the economy and they were really worried about the economy, then they wouldn't raise interest rates. And if they had not raised rates and the market tanked, that would be worse than anything. If the market tanks a little bit now, well, it makes sense in a way because they have raised rates, and raising rates does make it more difficult to do business and causes more volatility and stuff. But if they had not raised rates and then the market tanked, that would be the worst of all, because it would signal, A, the Fed's worried about the economy, and B, even without raising rates, we're selling off. So in a sense, the fact that they did raise takes off the table the worst scenario possible, which would have been that they don't raise and we tank. If they do raise and we continue to grind lower, in a sense, that's more acceptable than if they hadn't raised and we just completely tank. We'll have to see if this is another head fake or if we do actually indeed continue to grind lower. I think a key factor would be if the VIX did go up on the day here. I feel completely comfortable with my position being short UVXY right now, but I'm certainly not telling anybody else how to act. And as I said before, there is no penalty really for getting long. You know, if you get long UVXY or VXX when we're in sharp contango, you have a lot of forces working against you. But right now, it's actually you have forces working for you to get long volatility. Home builders. Yeah, home builders have been actually doing badly for a long time now. If you look at, like, for example, Toll Brothers, look at this chart. Not good. So I would think that, if I have the symbol wrong, I would think that that home builders have already tanked a certain amount already. So the question is, have they already adjusted to the downside appropriate amount, or do they have farther to fall? And currently down 15 on the E-minis, and approaching actually on the lows of the day right now. Let's go back to Powell and see what he's talking about.
Financial stability vulnerabilities are meaningfully above normal. And so that's a tool I'd be absolutely willing to use and happy to use at such time as that test is met. We meet and discuss that and evaluate it on roughly an annual basis. We haven't done it since early this year. I think we'll be doing it early next year, and we'll be reaching that judgment. Then I will tell you, I recently gave a speech saying that I believe that financial stability vulnerabilities were roughly at a moderate level. So for me, but I would want to leave my mind open on that and have that discussion with my board colleagues.
I'm not catching myself any specific wording here that is troubling to me, that why they would have sold off on what he said. I guess people will analyze it later and maybe catch something on that. But we're definitely selling off here. If we look at the Dow futures, for example, been quite a swing today.
Need to be restrictive, no, and I don't believe that it is. I don't believe that policy is restrictive.
Suggests it will be restrictive next.
We've had a 600-point swing from the high today in Dow futures.
Discussed this a couple of times. It's a very good question.
As we continue to sell off.
Just go back to this. The individual forecasts are not something that the committee votes on.
We're down close to 1% in the Dow.
And we write down
and UVXY now up on the day, 71.85. The VIX also up on the day here.
Ultimately, it's going to depend on what the circumstances are.
And we're more firmly in backwardation now.
It would be appropriate to go past neutral, and there would be circumstances in which it would be wholly inappropriate to do so. So I wouldn't put too much on. It does inform you the way people are thinking about things.
NASDAQ was down 100 here.
Take it as a signal about current policy or about near-term policy.
Hi, Paul Kieran from Dow Jones Newswires. Thanks for the question. In Dallas last month, you talked about the usefulness of speaking with businesses to sometimes hearing things that aren't yet showing up in the economic data. And I was just wondering if you're hearing anything from businesses that might explain the recent market moves. You know, are markets onto something that again hasn't showed up yet in the data? Thanks.
So if you look at the Teal book, or you know, we get the Teal book in person from the Reserve Bank presidents who come in and they share their discussions, not just with their directors, but with literally hundreds of business and nonprofit, you know, and labor union people around the country. And I personally find it really interesting. I mean, my background is very much working, starting with you know, a small group of people, maybe a company, and working out.
All right, so I guess I'm going to leave it here as we continue with the press conference here.
And, you know, what you're picking up now, I think,
we have sold off, certainly from the highs of the day, but
you know,
even from
or it's a mood of angst about growth going forward. If I could just capture it.
But we seem to be selling off on this news. We'll see what happens. There's still time to digest this, and I see it. I mean, in the context of the way things have been going lately, it seems sort of like a non-event, but much more sell-off, and it's going to turn into a sale here, definitely, I would say.
We'll just have to see. For now.
Now, there's no way of telling if they had not raised rates, if we would have sold off as well, but like I said, worst case scenario would have been they don't raise rates and we sell off.
To push back against that.
At least with the raising rates, there's sort of, quote unquote, more of a reason to sell off here. And I wouldn't be surprised if we do end up the day way down, then I'm sure that the president will come out and have something to say about that.
President Trump said recently that you should feel the markets. So when you see the markets, you know, what
I'm just checking on Twitter to see if there's been any reaction from the president yet.
You know, financial conditions, broadly speaking, we don't look at any one market. We look at a really big range of financial conditions. And what matters for the broader economy is material changes in a broad range of financial conditions that are sustained for a period of time. A little bit of volatility, speaking in the abstract, some volatility doesn't probably leave a mark on the economy. So we look for that. And, you know, what we've seen here is a tightening. There's been a tightening since right around after a week or so after the September meeting. And, you know, that we tried to factor that into our models of the economy and to the results that come out of those models. That's how we think about it. So we do, you know, we follow markets really carefully, but remember, from a macroeconomic standpoint, no one market is the single dominant indicator, and it really matters if changes are sustained over time.
Nancy Marshall-Genzer with Marketplace. Do you still think core PCE is a good measure of whether the economy is overheating? What do you think of
we are down after the decision here, folks.
Relying more on that.
The swing we have today is like fairly typical lately of stuff moving around. We're down over 1%. A year ago, a down 1% move would have been huge news. Right now, this is just kind of like par for the course again.
Inflation has become much less reactive to changes in growth.
As we see a sell-off now, VIX up on the day, UVXY 72. And
that time is behind us, and that is often attributed to the success of central
banks. And
banks.
Definitely back in backwardation here. We'll see if the sell-off continues. Thank you for joining me with the coverage, and I will see you again soon. I'm going to break off here. Thanks for watching, and I hope you make money in your trading pursuits, and have a great holiday if I don't talk to you before then. Thanks for watching, folks. We'll follow this closely
Now, it did move up last year.
as we move forward today. Bye.